Gold and silver, by the way. XAU.
Oh, gold and silver.
Quite a few silver miners.
Okay.
In fact, it's called the Gold and Silver Index. If you look back in the 80s, 90s, and into 2000, it lived in a range that you could divide. About 25% was about the level. In other words, its price was about 25% of the price of an ounce of gold. Okay. And the lows were about 17 and a half, and the highs were well over 30. Okay. So that was its living zone for multiple decades.
Yeah.
Then came the bear market all the way down to the 2015 low. It got down to 4%.
Yeah.
I mean, it got wiped out. Okay, the miners did. Okay, but since then, we're actually higher than we were 10 years ago on that spread. It was 4%, we're now 6.5 or so, okay?
Yeah.
So that's a 50% gain, by the way. It's like buying a stock at 4 and it's now 6.5, okay? So don't chuckle. It's not just 2.5%. It's a substantial gain. Look, go back there at where you got your line first drawn. See that cluster of sideways ink after that surge?
Yeah.
You surge up. Look at the number of, what is this, weeks or months? Months.
This is a weekly chart.
These are weeks. Yeah. Look at the sideways action there. Gold never tops with comatose sideways action. Okay, that's an example of it. Another one would be the next congestion zone you see there, where you tried to break it, came back up, tried to break it, came back. Gold doesn't top that way.
Yeah.
Now look at this. We're entering 5 months now.
Yeah.
Of absolute comatose sideways. Punch up a monthly chart. Look at the closing prices.
Yeah.
Have you ever seen anything so steady?
Oh, wow. Look at that.
Isn't that amazing?
I never noticed that. Look at that.
Even now,
boom, boom.
you got an up month. Okay. Now punch up a silver chart at the same time. Well, you've got that sideways action there. Silver monthly. Okay.
This is silver
Since
monthly.
April, go back to April.
April
Which is that big down. Okay, that month right there.
Yeah.
You went from that monthly close up to where you are now, and you've still got an up month by about 70 cents right now. While gold has gone sideways, silver's gained 10% or more.
Yeah.
Yeah. So again, gold, the mama market in the monetary metals, does not top going sideways. If you think it's going to top here, ask yourself the question, is that the way it ever behaves? It doesn't. 2011 top, 2015 low, 1980 peak. They're all, you never came back to the high.
Yeah. You had a spike up and then just kind of a blah.
You couldn't even get back to 1800 again in those two rallies that followed that 1900 peak.
Yeah.
You couldn't even reach 1800 again.
Yeah.
We keep coming back to the same high.
Yeah.
Okay, it ain't a top. Sorry.
Okay.
While gold holds steady, silver has quietly gained ground. Since April, silver prices are up more than 10%, even as gold barely moved. This divergence is important. Silver, historically more volatile, tends to surge once gold consolidates. Many analysts now argue silver could be the leading indicator of the next precious metals rally. Recent strength in silver miners supports this view, as they've broken out of multi-year downtrends. Silver is signaling that the broader monetary metals market may be on the verge of a major shift, with miners and investors finally ready to catch up to fundamentals.
Gold, raw gold, unleveraged gold is just holding cash.
Yeah.
It's like putting it in the bank. Gold holds its value over investment lifetime after investment lifetime in terms of the degradation of the money unit. Money supply doubles almost, goes up about 90% every decade. Population doesn't, by the way, so there's no excuse. In the recent decades, even more.
Yeah.
Gold, go back 20 years, 25 years, quarter of a century. And randomly in mid-2000, 25 years ago, summer 2000, S&P's up 3.5-fold. Gold's up 11-fold. Okay, so if you're just a dumb, unleveraged investor and you bought the S&P, you're smug and smiling, right? But you haven't been keeping up with the growth in the money supply.
Yeah.
The degradation in the real value of what you've got. Gold has held its value. It always does. Now, it may ebb and flow, but ultimately, and even when you go back 10 years, 5 years, 3 years, and plot where gold was then compared to S&P, gold's gaining the whole time.
Yeah.
Okay.
Gold remains the foundation of monetary trust. Unlike equities or fiat currencies, gold doesn't rely on growth, debt, or political stability. Over the past 25 years, the S&P 500 has tripled, but gold has risen more than 11-fold, outpacing inflation and money supply expansion. Every decade, global money supply nearly doubles, yet gold's purchasing power endures. Investors who dismiss gold in favor of stocks often overlook this hidden reality. Real wealth isn't measured in nominal gains, but in preserved value. As global debt spirals past $100 trillion in 2025, gold's role as unleveraged cash looks more vital than ever.
Gold and silver, by the way. XAU,
gold and silver.
Quite a few silver miners. In
Okay.
fact, it's called the Gold and Silver Index. If you look back in the 80s, 90s, and into 2000, it lived in a range that you could divide. About 25% was about the level. In other words, its price was about 25% of the price of an ounce of gold. Okay. And the lows were about 17 and a half, and the highs were well over 30. Okay. So that was its living zone for multiple decades.
Yeah.
Then came the bear market all the way down to the 2015 low. It got down to 4%.
Yeah.
I mean, it got wiped out. Okay, the miners did. Okay, but since then, we're actually higher than we were 10 years ago on that spread. It was 4%. We're now 6.5 or so. Okay,
Yeah.
so that's a 50% gain, by the way. It's like buying a stock at 4 and it's now 6.5. Okay, so don't chuckle. It's not just 2.5%. It's a substantial gain.
Gold and silver miners are regaining strength after years in the shadows. For decades, mining stocks traded as a percentage of gold's value, usually between 17% and 30%. In the brutal bear market ending in 2015, that ratio collapsed to just 4%. But the tide is turning. Today, miners sit above 6%, a 50% recovery, and recent chart patterns suggest a breakout could push them towards 17% again, a potential tripling. This isn't just theory. History shows miners often deliver outsized gains compared to bullion. For investors seeking leverage to gold's move, the miners may hold the real prize.
Yeah.
We've broken out in the last several months above a downtrend that goes back to the 2020 highs and above recent highs as well. So, you know, if you treat that as a price chart
Yeah.
and draw a downtrend or horizontal, you've broken out above that.
Yeah.
Remaining structure is up there at that 8% plus level, which you probed back in 2016, you probed in 2021, and you plot only monthly closes. You'll see if you get a monthly close up there well above 8%, you're breaking out. Now scan back to the long-term chart you had a minute ago. Okay, when you look at this chart, you say, okay, it's a price chart. Where's next resistance? Okay, you break out of the base. Where's next resistance? 17.5%.
Yeah.
Okay,
Yeah.
You'll see the multiple lows there, and then the rally high in 2009 that reached up to 17.5% and failed there.
Yeah.
It has marked the spot. So once you unleash out of this base, super cheap gold miners and silver miners versus the monetary metal itself. If they say, okay, it's our turn to shine, and we think that shift is already underway, that's a tripling in the value of the gold miners relative to gold, even just to get to the bottom side of the prior multi-decade normal zone. Tripling.
Yeah.
So no matter what gold does in the next year or two, the miners, if you continue this rally and you get up above that 8%, meaning go another 1.5% from where you are now, watch out. You could launch this beast. And there's no resistance until you get up to that 17 plus level.
Skeptics often ask, what happens to gold if stocks crash? History provides the answer. In the Great Depression, home-stake mining surged 1,000% while stocks collapsed. In the 2000-2002 dot-com bust, gold rose steadily. Even in 2008, despite a sharp sell-off, gold quickly rebounded to new highs while equities kept sinking. The pattern is clear. During bear markets, capital seeks refuge in real money. Analysts expect the next stock market downturn won't trigger panic selling in gold, but instead accelerate flows into bullion and miners. For global investors, gold has always been the ultimate crisis hedge.
Even if you just go to 17.5, you're retired.
Yeah, exactly.
You don't care.
Yeah.
So don't worry about it. The issue is already you're well off the lows we've seen in the last 10 years. So miners are actually, though it doesn't look like it, are gained more since their bear low in 15 than gold has. Even though when you look at their price chart, they're not above, which you don't have here, they're not above their 2011 highs. In this case, anyway, you get the point.
Yeah.
We're focused now on silver, and gold and silver miners as outperformers to gold going forward, likely dramatically.
Okay.
And personally, that's where I'm fully invested, is in the silver miners and gold miners. And when I ever want to move something to cash, I do, but it's called bullion. When you get a crash event in the stock market, which is rare, by the way, in bear markets in the U.S. stock market, 1929 began with one and then rallied halfway back to its high. And then the real bear market started from 1930 to 1932. Arduous arm wrestling bear market, no crash. Okay, look at the .com and the S&P to 2002. There was no crash. It got cut in half with no crash. In the 2007 to 2009 bear market, S&P got cut in half. There was a crash, but it occurred a full year after the bull market peak. Price had already imploded significantly in the S&P before you ever got what you could call a crash event, which is in October of 2008, half a dozen months before the final low, but a full year off the high. During that time, gold and silver miners ramped. Now, yes, when that crash did occur, and I'm not forecasting a stock market crash, by the way, I'm forecasting a bear market. Doesn't have to crash. In fact, that's sort of a rare event, as I've said. The gold and silver, gold has been the only place to be in all the bear markets in U.S. history. You go back to 29 to 32 and see what went up. Gold was illegal, but homestake mining wasn't. It went up like 1,000% during the entire bear market. Go to 2000 to 2002. Look what gold did during that time. Advanced the entire time and beyond. 2007 top in the S&P to 2009. Gold advanced except for a very bad month in September, October of 2008, where gold did join with stocks for that brief period, but then immediately went back to its highs within a handful of months, whereas the S&P continued down until March of 2009. So to look for examples of coincident negative behavior is rare. The primary trend of gold during stock bear markets is it benefits from the exit of flow of cash out of the stock market. It is an alternative. And this time, I think, because of the exaggerated nature of certain things, technicals and fundamentals, this time the gold bull market could be totally different than any other bull market we've seen. Meaning, when it goes up there, it doesn't come back down. It becomes institutionalized here, there, and pretty soon everywhere around the globe, as finally we go out of fiat money into something that's real money. The decision is made. We'll probably be the last to do that, okay? But a lot of countries are already, on an intellectual direction that way.
Today, signs point toward gold becoming institutionalized as core wealth insurance. Large asset managers, sensing fragility in the U.S. market, are already moving into major miners like Newmont, which has surged despite gold's sideways action. At the same time, countries across Asia and the Middle East are stockpiling gold reserves, preparing for a world less reliant on the dollar. If the U.S. eventually follows, the shift from fiat toward tangible value could be historic. The next bull market in gold and silver may not resemble the past. It could be the foundation of a new global monetary era.
In fact, right now, I'm looking for the S&P breakage. Not a crash. I don't think that's what you're likely to see. To help spark a more rapid flow of money into the gold and gold miners. In fact, if you'll look at the gold miners, like what's been going on here, Newmont Mining, which is not an outperformer at the present.
Newmont, okay.
Yeah, Newmont is a good example. Go back many more decades if you can, 2007 or 8.
Okay, Newmont and boom. Okay, there we go.
Yeah, there you go. Look at its prior peaks. Now look where it is now.
Yeah,
I mean, you're challenging its all-time highs. There were some spikes up there
yeah,
that were very brief. You can see that like 1 month, that kind of thing. We just Newmont, gave a buy signal in I think it was April of 2024 when we were coming up through $40, 30,
yeah. That was amazing,
30s,
wasn't
yeah. And
it?
it had a sharp pullback after that, but it didn't change the momentum trend. And now you got through, there was a horizontal level of price resistance where they wouldn't let it close over $54 for a couple of years because prior monthly close lows had been $54. When we burst through that, we ran up to 70 in a heartbeat.
Yeah,
So even what's going on here? I mean, gold's been dead sideways for the last 4 or 5 months, yet Newmont has gone from the $40 range up to 70. What it indicates to us is there's some big asset managers out there
yeah.
who are getting doubtful of the stock market. As I said, the distribution highs early this year. Somebody said, get me out of this beast, okay?